Let's look at each of these three examples in turn. So let's start by drawing our starting point. So an initial equilibrium in our market for loanable funds. Here's our upward sloping supply curve, our downward sloping demand curve, and the current equilibrium, Q star, R star. All right, so the first example says, what happens if the government reduces the size of its deficit to zero, right? So here we're thinking about the supply for loanable funds because the supply is comprised of, as you will recall, national savings and net capital inflows. So for this example, we're assuming a closed economy, so there are no capital inflows. So it's just going to be private savings and public savings, which together comprise national savings. All right, so if there's currently a deficit, that means that currently public savings are negative, less than zero, and now that deficit is going to go to zero. So that means that there's going to be an increase in public savings from a negative number up to zero, and therefore an increase in the overall supply of loanable funds. So this is like the opposite of crowding out by government spending of private investment, right? We're moving the supply curve out as the government sort of eats up less of the supply of loanable funds, right? And so now we can take a look at how we'll transition to a new equilibrium. Right, at the current interest rate, there's a disequilibrium. Currently, the supply of loanable funds has increased, so the quantity supplied is higher, while the quantity demanded is still down here. So the banks have all this extra cash, and they want people to start borrowing it because that's how banks make money. They charge interest on loans and make money. So they're actually going to the banks are going to lower the interest on the loan in order to encourage borrowers. Borrowers are going to say, hey, look, money's cheaper, so let's borrow more and fund some of those investment projects we had been sitting on. But at the same time, some savers are going to be disincentivized from saving because they're earning a lower interest on those savings. So eventually the two sides balance out, and we end up at our new equilibrium Q star 2, and that happens at a now new lower equilibrium interest rate R star 2. So overall, what we saw happen was an increase in public savings. That led to a drop in the interest rate, which decreased a little bit our private savings, right? But at the same time, the lower interest rate encouraged borrowing, and a lot of that borrowing is happening to fund investment spending by firms. So in general, we would expect this higher quantity of loanable funds to be fueling investments in physical capital per worker, new technologies, all of which are going to raise our GDP per worker, our productivity per worker, right? If capital per worker increases and technology improves, then both of those are going to increase GDP per worker, leading to higher living standards, all else equal. Let's start with a blank slate here for our next example. So this one says, at any given interest rate, consumers decide to save more. Assume the budget balance is zero, right? So if we're talking about a consumer saving more, what we're talking about is a part of national savings, and in particular, we're talking about private savings increasing. Right? So if that happens for whatever reason, it means that the supply curve is going to shift out. And so we'll have this new supply curve. I'll call it S2. Right? And now we can see how the market's going to adjust to its new equilibrium. At the current interest rate, we're now out of equilibrium. The quantity supplied has just increased, right? But the quantity demanded is still out here. So this is our disequilibrium. And now the banks have a lot of additional funds floating around, and they would like to loan those out. So they need to increase this quantity demanded for loans. So how do they do that? Well, they make it cheaper to borrow money by lowering the interest on the loans. So as that interest rate starts falling, the quantity demanded is going to increase. We're going to see companies go and borrow that money in order to fund those projects that weren't quite profitable when the interest rate was up here, but now are going to become profitable as the cost of money lessens. On the other hand, though, we know that lower interest rates disincentivize some savers, right? And so we're going to see a decrease in the quantity supplied, sort of a lashback to this initial increase. And eventually the two sides of the market will meet at our new equilibrium Q star 2, right? And that will happen once the interest rate settles to this new lower equilibrium R star 2, right? So as a whole, we see that the quantity of loanable funds increased, right? And the cost of those funds also decreased. And so we should expect with this increase in borrowing, an increase in investment in capital per worker and technology per worker. All of those things are going to raise labor productivity, which we know is a precursor for long-run economic growth. For the third example, we have the following prompt. At any given interest rate, businesses become very optimistic about the future profitability of investment spending. Assume the budget balance is zero. Right, so if firms become optimistic, they maybe think the economy is going to see a big increase in consumer demand for their products, and they want to be able to meet that higher demand, so they're going to ramp up, their capabilities, right? So for that, they're going to have to borrow money, and so all else equal, we'll see an increase in demand for loanable funds. Call that D2. Right? And so we know that that change is going to move us to a new equilibrium in the market for loanable funds, right? So let's see how that happens. So the first impact here is that we're first thrown sort of out of equilibrium, right? The quantity demanded for loans is now high, while the quantity supplied is still down here, right? So banks would like to be able to make more loans to meet this now higher demand, so they need to increase the supply of loanable funds. How do they do that? They do that by increasing the interest rate that they offer on savings accounts, for instance. And so that's going to incentivize savers to put more money into their savings account, right? At the same time, some of the potential borrowers are actually going to fall back and not borrow the money because the cost of borrowing money is becoming expensive. And for some of our potential borrowers, that might mean that their investment projects are no longer worthwhile. So eventually the two sides of the market meet at our new equilibrium Q star 2. Right, and at the new equilibrium interest rate, R star 2. Right, so let's assess what happened here. Right, in the end, the interest rate is higher, right? So loans are more expensive, but there are more of them being made regardless because of these other external factors that are driving a desire for more investment spending and therefore requiring more borrowing, right? So in terms of economic growth, we would expect this higher borrowing, which is fueling private investment, to increase capital per worker, the technology available to our workers, and therefore increase GDP per worker, driving economic growth.